So we have a legal bill, Mariner Investment Consulting Services, which is a flat fee quarterly, plan administration, custodial fees with Salem Trust, another plan admin bill for October, another for November, and then 2 actuarial invoices for a total of $40,724.72 coming out of the fund with this warrant. And then the final component of the consent agenda is the fund activity report, which is on page 18 of 131 on the tablet. And as a reminder, the fund activity report is just any new member activity impacting the fund, whether it's somebody has retired, maybe they entered the drop and so they're no longer contributing to the fund. In this case, the activity is just a retiree did pass away. His benefit was ceased upon death as per his election. And a firefighter did begin purchasing prior military service. He started with biweekly payroll deductions, and he intends to refinance that payment with a lump sum from his FRS contributions once the ordinance is changed to allow for that. So, any questions about any of the items in the consent agenda?
Nope.
When's the ordinance should be changed? Basically after today, right?
So the ordinance that codifies the contract changes was adopted, but it doesn't have any of the buyback language, and it's just that little sentence basically that says, you know, the payment method shall be elected in advance and is irrevocable. Right. That's the language that's just in the way right now. That was not addressed in the ordinance, so we'll have to submit something separate. I have that under, I think, old business.
Okay.
Any other questions? Then we need a motion.
And the consent agenda can be approved all in one motion, so the invoices and the fund
Right.
activity report together can be approved in one motion.
Correct.
If that's okay with you guys.
Yep. So we,
Approved. Second.
all those in favor signify by saying aye. Aye. Opposed, motion carried unanimously. New business, discussion of the use of monitors.
Yeah, and just for reference, on page 19 in the tablet is just an email that I received from Alicia Oates. She's in the IT department. She's also a trustee on the General Pension Board. She reached out to me about a week ago and just asking if there was any issue with the monitors being removed for pension meetings. And I reached out to Bill. I reached out to Dylan Renz from the police board. And, you know, Bill wanted to talk about it a little bit, and I think you guys can let us know if that's something we need to get back into implementation. But from my standpoint, I don't remember ever using them for pension meetings since I've been the administrator on all 3 plans. But certainly, I work for you. If you want to see monitors, then...
Well, we don't see them. The only thing that I guess gets put on a monitor is on the screen behind us. And I know Patrick was playing with something before for the general meeting, but if he didn't have that, then he wouldn't be able to show that. The only downside, and if we don't use it, we don't use it, but people that are watching this on YouTube or watching it live,
They can't see anything.
the thousands of people that just want to see us, won't be able to see anything. So if we're
Yeah.
talking about numbers like this, they have no idea what we're talking about. They just words. So, but I don't know.
And also, if we have the attorney before we'd have the monitors, if they're zooming in. we're gonna
Yes,
need
that's
monitors.
right.
Okay,
Yeah.
okay. So that's definitely something to consider. I know I spoke to a gentleman in IT, and I guess that projection is a mirror of that laptop at the podium. So when Patrick gets up, and it's actually not during this meeting, he planned to do it during the general pension meeting, but he has a flash drive, he's gonna plug it in there, and it'll show there. So in the event that the attorney needs to zoom in, I think we can do the same thing as long as that computer has internet. Bring the attorney in there, they won't be able to see you. No, they won't be able to see you, I don't think, unless they're watching on YouTube, but they'll at least, we can see them, and we should be able to hear them as well. So that's something to think about, but totally
Yeah.
up to you guys. I'm happy to discuss more with the IT department.
Well, I don't know if they've improved their visuals. The last time we tried to do a Zoom call or something, it was a disaster. I mean, that hasn't worked. Now, I don't know if they've done anything to fix that, or perhaps we just have to take one person's laptop or iPad or something and make our own Zoom.
That could be. I just did that at Northport
It
yesterday.
won't be that big, but
And that could work. We could set up a table here. You know, I usually have, I don't today, ironically, but I usually bring my personal laptop, and we could always set it up right there. I guess, you know, that would be difficult for the people on YouTube to
they
hear.
would, yeah.
We could put a microphone there so they wouldn't be able to see, but I think we could make it work.
Yeah, until we get more permanent space, we're going to have to just deal with this the best we can. Yeah, whatever year that becomes. Well, I think they're going to start working on that now.
And the other thing I was thinking too is if somebody were watching on YouTube and there was something mentioned or a document presented at the meeting and they wanted to make a public record request, they could reach out and say, hey, can you please provide me a copy of that asset allocation review?
And they could go on the city website and go on the agenda and pull out those
Absolutely.
things. It's pretty complicated, not for someone to do, but I guess
For
they could do
someone.
that.
So this is okay for now, and we'll just maybe
Yeah.
play it by ear?
Yeah, I think that makes sense.
Okay.
Legislative updates.
Yes, so starting on page 20 in the tablet, this is a legal memo that came from Ken Harrison's office, basically about 2 new statutes that were adopted that impact contracts with the board's vendors. One of them just prohibits any non-governmental entities doing business with a governmental entity. They have to provide an affidavit confirming they are not an entity or not doing business for any of the foreign countries of concern that have been identified in the memo. That's, you know, China, Iran, Sudan, the Venezuelan regime of Nicolas Maduro. So, and I actually have the affidavits from your vendors in the packet, so you can see that your vendors have complied with that statute. The second statute is another one where your vendors have to provide an affidavit confirming they do not use coercion as a labor practice. And so that's it, just a quick update that if there are any, hey Danny, I'll make a note for the record that you have arrived. That's okay.
Thank you, Chrissy. So this is really information only. We're going to follow the law, obviously.
Correct, it is
I
information
just
only.
asked Chrissy to put it on there so you knew what was going on. Hi, Danny, how are you?
Morning.
Good to see you. Okay, let's move on to actual expenses.
Okay, let me just make a note here that Danny arrived so that it makes sense why the number of votes changes. Okay. So Danny, on the tablet, we are on page, the actual expenses are on page 29 of 131. And I'll give you a minute to get there, but basically, every year before the fiscal year begins, you are to draft a budget for your administrative expenses, pretty much all your consultants, actuary, administrator, attorney, auditor, if there are any auditor fees, Salem Trust, the custodian. I gotcha.
I stole his because this one wasn't on.
This is for future reference, I usually, actually, I should say always, because sometimes I forget. Here, and then for the bookmarks, we are right here.
Thank you.
You're welcome. So the plan is required to operate under a budget of administrative expenses. The budget you set for the fiscal year that has already ended as of September 30th, 2024 was $128,500. As you can see from the far right column, you came in well under budget. The actual expenses as of September 30th, 2024 were $93,445.40. So while there are a couple line items where you went over budget, that's okay, as long as that total aggregate number was not exceeded, and it was not. So everything looks great, and if there are no questions, we do need a motion to approve that report, since that does get sent to the state, whereas the budget itself doesn't, the actuals do.
Make a motion to approve the budget.
We have a motion and a second to approve the budget. All those in favor signify by saying aye. Aye. Opposed? Motion carried. Thank you.
Excellent, thank you, we'll get that filed.
Discussion of the quarterly post-retirement.
Yeah, so this actually, the PRIA is a pretty new part of the plan. That's the post-retirement investment account. And this, I just have a section from the ordinance on page 30 of 131 in the tablet. Because it's so new, I think there are some things that are still needing to be worked out. And 2 of your retirees have their money in the PRIA. One of them actually reached out to me and asked if it would be possible to, instead of getting one annual update of the balance after the fiscal year ends, could they get quarterly updates that show, after each quarter, based on the net returns of the plan, how much money did their account make instead of having to wait a full year? So I said I would bring that to you today. And it looks like Patrick is here to assist with that because it is pretty new. I personally don't have a ton of experience with a PREA, but all it is the retirees leaving their money invested with all the plan's assets. So it's basically having a professionally managed portfolio. You get Carrie and Jorge to manage the portfolio, and you can keep it in there until you're 70.
72.
And you can take up to 4 withdrawals a year. But, if you don't know what your balance is at any given time, I think maybe
Couldn't they see that on the portal?
That's a good question. If it's up,
If it's updated on the portal, then why do we need to run
I don't know
reports
if
for
it's updated quarterly on the portal. Do you know, Patrick? That's a good, yes,
We can.
but it's not,
Like the drop, some of our plans, we do put the quarterly drop updates on there, except PREA, we only do the annual updates, right?
Yeah.
correct. So that's why I was thinking if the
makes sense.
retirees are only getting annual updates, then the portal is
People know,
probably the
sure,
same,
quarterly makes
right?
sense.
Correct.
Okay, so the portal is only showing the annual. Now, I talked to, I don't remember if it was John or Ray. I have talked to both of them, but, I was able to say, based on, these quarterly net returns, like this was the net return for this quarter and this quarter and this quarter, and we kind of worked it out. But I think it would be nice if every 3 months or so they get a statement
too.
saying, these are your earnings, this is your new balance.
Is that a cost?
Well, it does say in the ordinance, it says, a member may elect to receive a distribution of all or a portion of the PREA account up to 4 times per year at a fee of $60 per distribution, which I'm going to let Patrick speak to where that fee comes from.
Well, it's just our calculation to do drop updates, because we get the return from ANCO, and then we calculate their new balance.
Right.
And it used to be $60 each time we would do that for somebody, and now it's like $105 or something.
Yeah, I don't know if you remember a year or two ago, this is my whole argument with our attorney at the time, because I was arguing the contract states that it's 60 up to 220. Basically, if somebody's running numbers, it shouldn't cost the pension money. It should be on the
The
member.
fund, you're right, so that if we did quarterly updates for them with
It would
that
be-
concept, they would have to pay that fee each
They would
quarter.
pay the fee, correct. Which
So-
I'm fine with if somebody wants quarterly updates. The whole point of the PREA is not to cost the pension.
Sure.
Right.
So if they want updates, yeah.
So we could ask them, really, if they want updates quarterly, then we can do that, but they would have to pay the fee.
Right. That's what I'm getting at. So,
That sound reasonable to everyone?
yeah.
So does any action need to be taken, or I can just work with so far there's only 2 of them, but those 2 retirees, and just say, hey, look, if you do want quarterly, just keep in mind that the update will need to be paid by you, and that fee is, you said well, it says 60 in the ordinance, so is that?
The ordinance is wrong.
So I'll tell you,
It's 60 and then up.
Okay,
It's 60, and then anything over, it can be over. It's in the contract that
okay.
basically anything shouldn't cost the pension money.
So whatever the actuarial fee based on that
Yes.
contract
Right,
is,
that's-
you're saying
it's
it's
on there.
100 something?
Yes.
And that will be deducted from the PREA balance, or they need to actually mail a check?
Nope, we'll just deduct it from the PREA balance.
Thank you so much. I will let
Perfect.
them know.
Okay, so let them know.
Thank you.
Anybody have any issues? Good with that? Okay. Okay, responses for legal services. Well,
Yes, and there are hard copies of this. While it is in your packet, I did print, number 1, the summary of responses that came from JD, and then he sent a follow-up. Okay, so there are 2 things here. There's probably some information in both that are the same, but I'm going to let Bill take the lead on this because I'll be honest, I did not look at the responses. I didn't want my bias to come into play at all, so if you have any questions for me, I'm happy to answer them.
thank you. So as we began this process, 2 things became concerning to me, so I made a couple of changes to what we said at our last meeting. And you could certainly question whether I had the right to do that, and I hope that it will make this a better process. As you've all seen in the responses, they're extremely detailed. So I asked Foster and Foster to consolidate that information to what I thought was the most important things that we would want to look for. I also could not see any reason that we should have all 5 respondents come this morning to present to us. It seemed apparent to me that we should be able to narrow this down in this process to no more than 2. And I think we can do that. And then if we want to bring them, then that's the next step. But I think we can narrow the list down simply by looking at a couple of things. One of them would be fees, and the other is experience. You know, how many plans are they running? And we have that information. So if you'll indulge me for a couple more minutes, I'll just take you through my thought process, and this is only my thought process, okay? First of all, retainers don't seem to make any sense to me at all. The responses were all across the board. And if you look at the last 2 years' actuals for attorney's fees, last year, 2023 was $14,005. This year has been only $4,000. And that's because in 2023 we had a disability retirement, which caused considerable legal expense. So to me, it's better to pay as you go. I think that's better for all parties, myself. So I believe we should take the retainers out of the equation, if you will. Costs, hourly rates in travel, with the exception of one, Klausner, who is between 23 and 54% higher. The other 4 are pretty close. So here again, in my mind, I kind of put Klausner aside. When you look at experience of the 4 remaining, again, my mind, Murwaza, however you say that, only has 4 fire department pension plans. Donnelly has 3. Of the other remaining 2, Laurium has 13, and Sugarman has 56. And again, this was my thought process, and before I go any further with my thoughts, I'd like to hear what you guys thought. I'm sure you tried to get through those packages, and I see what you're thinking and see how we want to handle this and move forward. Anybody?
Yeah, I see what you're saying with how many plans they have. Reading through the packets, the biggest I was impressed with was Donald and Gross was my biggest impression, is who I'm leaning more towards. Obviously, Sugarman they do have a lot of plans. I had multiple issues, but it's why we're going through this process. Honestly, I brought this up. I wanted somebody that did represent plans. Like I said, though, to reinstate, since my mic was off, with me going through it and reading all their proposals, I was most impressed with Donnelly and Gross, was my opinion. I mean, once again, like you were saying, that's just my personal opinion. So.
A question to you about Sugarman. I think the issues were probably with the attorney that we had at the time.
Yeah. Honestly, I really didn't speak with the attorney that much. It's mainly, it seems like the only thing you get done is through the secretary, but you're paying attorney fees.
Oh.
But honestly, like what we just went over with the paying with PREA, anything like that, how it's wrong. That was, 2 years ago, I tried to get the reinstatement done, and it took over 2 years, and there's still errors, and that was the attorney that did it. So.
Well, I know it's been a little confusing with Ken. I think I've been on the board for 10 years, and he's been retiring for 10 years, and each year he comes, then he's back again, and it's like, surprise, surprise. And so it's been a little confusing with that, but again, you've dealt with them directly, so I can't dispute that. I've not had any issues with them. They seem to have done okay, but anybody else have any thoughts?
I'll kind of second Donnelly and Gross. They represent other plans within our local. They represent them well. They're personable. They kind of call back immediately. You get the attorney when you speak with them. So, but like I said, I've heard zero complaints from any of the other plans that they represent. I know they do a lot of law enforcement and whatnot too, but their fire pensions, they represent them well. So,
Okay. Garrett, you have anything to add?
No, it's, certainly if you have a history with Sugarman and they're not your preferred at this point, despite looking good on numbers, you know, it might make sense to look to the other ones that you're more interested in. I guess coming from a legal background, the retainer agreement is interesting to me and based on what it includes. I mean, we're maybe not moving forward with Sugarman, but their retainer is pretty comprehensive and right along the lines of what you're currently paying for legal representation. But otherwise, my sense from reviewing all the packets is that any of these firms and the attorneys would competently or appear to be able to competently handle whatever the board might need from them. So it's going to be a function of basically client services for you guys and you know, and for us and for how responsive they are and you know, how well they take care of the board. So with that being said, if Donnelly is, right, it was Donnelly, the ones you guys were talking about, is a plan that you guys also have, it comes highly recommended and they're responsive and competently handle any of the issues that come up. I think they should be one that comes in and gives a little bit more information. Their numbers of the number of pension plans for fire that they handle are kind of low. So I'd like to hear a little bit more about their firm and their history. And then, you know, if there was, you know, if you brought in like a Klossner or one of the other ones that really seems to have a lot of these types of plans, we could at least have something to compare and contrast.
I don't disagree with that. I guess the question is you mentioned Klossner, that's the most expensive one, hourly.
They are, but we want to make sure two things, that we're comparing apples to apples, and that what the client services is. So if you're getting one that is inexpensive or has, you know, it looks like it's all under the retainer agreement, if you're only then speaking with secretaries, you're not getting your money's worth.
Right, for sure. Well, okay, what do you think about those ideas?
Yeah, he makes very good, valid points. Right.
And do we want to do Klossner? That doesn't make any difference to me. That would be fine.
yeah, I mean, obviously, we've been disappointed with Sugarman. So Klossner is another big name in the state as far as representing plans, so it would make sense to kind of do one and then the other. At worst case scenario, you at least kind of, like you said, comparing apples to apples and figuring out services.
And also, the Klausner Group, they represent the General Pension Board and the Police Pension Board, so they'll already be here at the next meeting. They would just need to get here early
that's
if
right.
you wanted to speak with, her name is Blanca Greenwood. Now, they have other attorneys, but she would already be here.
Well,
Some of the other things we might want to talk about are the length of the retainer agreement, if that's what we went, or you know, how long we're sort of on the hook for, if we're thinking about this, how long the expectation is that the relationship would last. If for some reason we're happy with services, how easy it is to disentangle.
well, do we need to do a retainer thing, or we're not doing that with Sugarman now? We just pay him as we go, I believe. So, and now I may be wrong, and you will probably have a better handle on this than I. But I just seems to me it's more fair to both sides if you're just paying as you go. You know, you pay for the services you use, because we don't use that much.
Right, and
Typically.
I think they've, and I'm not disagreeing, but I think they've priced the retainers based on, they're all, I mean, like I said, they're kind of over the map, but
Yes.
they're all right around what you guys have been paying. It just depends on what that retainer includes. I don't have a strong opinion either way on the retainer or not, because it looks like anything that's truly winds up being a big ticket item is going to be hourly anyway.
Right.
So, yeah, I'd be fine with a pay-as-you-go hourly.
Just thinking out the box. Well, do we want to do that at the next meeting? You want to bring the two of them? Is that what I'm hearing? Okay, then let's entertain a motion then to do that, and we'll move forward.
Okay, so I would move to bring the Klausner Group and Donnelly in to respond or provide some more information for the RFP in the next meeting.
second.
Okay, let's, when we notify them, Chrissy, you can do that for us?
Absolutely.
Should we do like a time limit? I don't want them to ramble on for an hour and a half or something.
Absolutely.
Like a 15-minute presentation or something, whatever, 20 minutes, whatever we,
Yeah, I think 15 seems fair.
I think so. I think that would be plenty.
Question though, because I know like when we sent the RFP out and whatnot, we didn't talk about specifications we were looking at, like especially not having a retainer or anything like that. It might be beneficial to kind of, if we want to break it down a little more than that and say, hey, this is something we're looking for as well, whether it's no retainer, attorney showing up to every meeting, zooming in, or kind of, what we actually want as our parameters, because we kind of just sent a vague RFP. So getting, just because they sent us a retainer doesn't mean that's their standard practice. Maybe that's their standard practice of what they usually do, but if we're looking for something different, we should probably be forthcoming with that, prior.
I think we did ask for a retainer and hourly, but
Okay.
a valid point.
Okay.
Do you all have a preference? And I'll be being new to the board, I don't, but do you have a preference on if they attend in person, or if it's once a quarter they attend, or if they're only in Zoom, or any of that?
That was the next thing I was going to talk about, so I'm glad you, no, that's all right, I'm glad you brought it up. We don't usually have the attorney comes here once a year, December, typically, or we put them on a Zoom. And honestly, I've never seen a need for us to have an attorney here. I mean, we rarely have a question, and if we do, we could just, bring them in the next meeting. What I was going to suggest is that we don't have them come to the meetings, and if during the 3 months that we're not meeting, if some issue is presented to me through Chrissy or me or who's ever sitting here, that you authorize the chairman to contact the attorney and bring him to the meeting, because we know we're going to have questions that he needs to answer, rather than just bring him here for no reason. It's just money out of the pension.
Or Zoom, or Zoom.
Yeah,
I don't have a problem with Zoom.
yeah.
If Chrissy brings in her computer that we can use.
Yeah,
because
well, that's
not gonna work.
figuring out how to make it work, yeah. Well, worst case, we can do a conference call. We've done that before, too. We just don't see each other. And
Which, it's fine.
So, okay, so we have a motion to bring Klausner and Donnelly in for our next meeting to do about a 15-minute presentation on what services they have. Will we have a second? I forgot. Okay. All those in favor signify by saying aye. Aye. Opposed? Motion carried. Thank you. We got through that pretty quickly. Next up, Patrick.
It's faster than what I thought.
I'm sorry, why do I keep skipping things?
I
Pardon me.
I tried to keep it on one page, and maybe everything's a little too close together, so
No,
I
that's okay.
apologize for that.
Yeah, go ahead, let's do that. Let's stay in order.
Let me just plug in this wired mouse, because apparently this one died on me. Okay. All righty. Okay, so as far as the update on the plan restatement and collective bargaining agreement, this starts on, let's see, where do I have this on the tablet? 42 is the ordinance that was adopted, ordinance number 2025-2024. And unless I missed it, it does codify the changes that were agreed to in the collective bargaining agreement, so the new member contribution rate is in there, the drop extension with the sunset, but there is no mention of that buyback language. So I didn't know if that is something you guys wanted to address today. I mean, the agreement has already been ratified, so I imagine it wouldn't be difficult to get adopted. Buybacks are a no-cost item. So, for example, if, Dylan, the member in question who wants to refinance his purchase, he started with payroll deductions, well, that includes interest. So over time, he's gonna end up paying more than he would if he paid in a lump sum. So he wants to put down a lump sum of his contributions from FRS, but right now the plan doesn't allow him to refinance. And so that's what we're trying to do, is eliminate the restrictive language that says that the payment method for buybacks shall be elected in advance and is irrevocable. That's the one thing that's not in here. So I was thinking if you guys did want to move forward with that, maybe we would talk to the attorney and have him draft a little ordinance amendment. Patrick can do a letter of no impact, and we send that to the city for their consideration. If you still want to move forward with that?
Well, it's in the contract, we have to move forward with it.
Okay, okay.
Yeah.
I don't understand how it's not an ordinance, to be honest with you.
It sounds to me more like a city clerk issue, not for us to be paying for. If it was in the contract, somehow that got missed. We didn't,
We didn't.
our attorney didn't draw it.
No, they drew it up with the city attorney prior.
So somehow they missed it.
So maybe I'll just start with the city attorney and the city clerk and just say, hey, this was agreed to in the contract, and is there any way that, I don't know if an ordinance that's been adopted can be amended, or if it would just need to be a brand-new ordinance, but I will find out, and I'll report back. You're welcome.
Excuse me. Okay, Patrick, now.
So the actuarial valuation for you guys today, it is not within the packet. So on the tablets, if you tap the screen, there should be a little arrow that appears in the top left-hand corner of your tablet. Tap that arrow, and you should go to the home screen of the tablet. And if you click on the icon that says 10/1/2024 AVR, Fire, Actuarial Valuation Report, that is the electronic copy. That way your page numbers match Patrick's. Anyone need any assistance? Great.
You guys got it? All right. Well, if you go to page 6, what page do they start on, or will it?
They have the same page.
All right. So every year as of October 1st, we look at the assets in the pension plan, and then we project out everybody's future retirement benefits. So we get an appropriate funding requirement for the next year. And the costs went up this year for a couple different reasons. But so we always do it 1 year ahead so that the city can budget. So for the current year, that's on the right-hand side. That was a snapshot as of October 1, 2023. And the requirement, total requirement is $1,107,000. And after the members' contributions, the city and state requirement is $861,283 for the current year, and then $1,155,000 for next year. And part of it is because we had salary increases and a little bit of growth in the department. So, you know, if the costs are 25% of payroll, well, if you have higher payroll, then it's going to be a larger dollar amount. So that's part of it. And part of it, I'm going to go over here and we'll try the other screen here for you.
Is this for them to see, so they just need to turn around?
Yeah,
Oh, okay.
but it's not working right now.
Oh.
You know what it is? Well, this is page 6 from last year's valuation report up here. And so I wanted to show you guys the unfunded actuarial accrued liability. So you know how we have all those separate little mortgage payments? So last year, there was a payment, a gain from 2014. We had an actuarial gain, and we basically had a negative payment. See, most of the liabilities are positive, so it works like a mortgage payment where you have a payment each year. Well, in 2014, we had an actuarial gain, so it was a credit. So we get a credit each year for 10 years. And so it was a credit of $153,000 a year. And last year's valuation report was the end of it, the last time we get that credit. So we fully recognized that actuarial gain. So the cost in this report goes up by $153,000 just because of that little piece. Does that make sense? So it wasn't that you had terrible experience this year. It's just you paid off a negative unfunded. It's the last year of a credit. Does that make sense? Yeah. Okay. Now I'll go back up to the other one. But the investments is on page 32. So you guys had a great year in the investments. I mean, phenomenal. So if you go towards the top of the page, last year we had $20,540,000 in the plan. This is under development of investment gain or loss. We had $20.5 million in there. And we have a 7.45% assumption. So we're expecting to get 7.45% every year. And we actually got 20.6% last year. So we expected to earn $1,534,000, and we actually earned $4,268,000. So we had a gain there over and above our assumption of $2,733,000. So if we were not smoothing, that page 6 would look a lot different. The costs would have come down probably, but we always use that smoothing so that the city's costs don't go way up and way down each year. And so in the upper left-hand corner shows you the gains and losses from each of the last 4 years. 2021 was a big gain. 2022 was a big loss. And then 2023 and 2024 were gains. And if you add all of them together, it was a net gain over the last 4 years. The smoothing was 7.85%, and we have that 7.45% assumption. So using the smoothing, at the bottom of the page, you had a net gain of $88,000. You know, if we weren't using the smoothing, it would be a gain of $2,733,000, but we are using the smoothing.
Patrick, for the benefit of Garrett and Danny, would you just do a little brief description of what smoothing means so they understand?
Yeah, when I said at the beginning that we looked at the assets and then we looked at the liabilities, well, the assets have a lot of volatility because you're heavily invested in stocks. So your assets are going to go up and down every year. What we do for smoothing is we create an actuarial value of assets. And it's basically a smoothed value. And in this case, we're taking the market value of assets, which was $24,915,000 we had in the plan. But for actuarial valuation purposes, we're spreading out some of our gains and losses. So in that upper left-hand corner, this year we had a gain of $2,733,000. Well, we're going to defer $2,187,000 for the future. We're going to recognize $546,000 a year for 5 years. So we're spreading out that gain. We're not recognizing it all immediately. And we did the same thing with the loss in 2022. We had a $4.9 million loss, and we're recognizing $1 million a year for 5 years. So we do the same thing every year so that we don't have a huge fluctuation in the city's funding. Does that make sense?
Yeah.
And so the great news on that page is that 2.7 million gain this year, that's going to help us each of the next 4 years. So it was a great news on the investment side. If we wouldn't have had a big gain this year, our smooth would have been below the assumption because of that 2022 year. But basically, we made up for that 2022 year with our wonderful 2024 year. So then on the liability side, the turnover makes a big difference on page 40. So the top of the page is your active employees, not in drop, because drop members we treat like retirees. You didn't have anybody in drop anyway, but if you did, they would be on the bottom of the page. So you had 32 active firefighters 10/1/2023, and you had one person terminate vested, so they had more than 10 years of service, and they just weren't at retirement age yet. So they're going to get a retirement benefit down the road. And then you had one person terminate non-vested, and they took a refund of their contributions. So that turnover was a little bit higher than we expect. So we had a slight gain on turnover there. And then the sad part of this whole report, though, is the bottom of that page. You had 2 retirees pass away. One was a retiree, and one was a disability retiree. But both of them passed away with no survivor benefits. So now, obviously, that's a gain to the plan because we don't have to pay annual, monthly retirement benefits anymore. So then, if you go back to page 17, one thing that I didn't mention yet is salary increases, individual salary increases. So if individuals get bigger salary increases, well, now their benefit at retirement is more valuable, right? Because it's based upon their final average salary. So this year, the average salary increase was 11.2% when you compare fiscal 2023 salaries to fiscal 2024 salaries. And so that was a loss to the plan. It increased the liabilities. And so if you go to page 17, last year our unfunded actuarial accrued liability was $2,175,000. And with payments, we expected it to be $2,430,000. And in the end, it was $2,698,000. And so we really had a net actuarial gain. All the regular experience of the plan pretty much washed each other out. So we had the investment gain, we had the salary increase loss, we had the turnover gain, the mortality gain. And so in the end, it was basically neutral. All the experience washed each other out. But then you guys had approved lowering the investment return assumption. We lowered it from 7.45 to 7.35%. You guys had approved that at a prior meeting. And so if you lower that investment return assumption, well, you're further behind, right? If we have the same benefits and we think we're going to earn less, then we're further behind. So that unfunded actuarial accrued liability went up by 271,000 because we had the assumption change. So the cost would have went up still for the city, but not as much, but we did the assumption change. And I think the city was on board with that, you know, just to be more realistic and conservative in our assumptions. So those were really the highlights of the valuation report, but I'd be happy to answer any questions.
Anybody? Thank you. That was good, Patrick. Nice
Thank you.
job.
We do need a motion to approve the actuarial evaluation as presented.
I'll make a motion to approve.
We have a second? Second. We have a motion and a second. All those in favor signify by saying aye. 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 Opposed? Motion carried unanimously. Okay, Mariners.
I almost said good afternoon. Good morning, everybody. I feel like I've been up a long time already. Thank you for allowing us to be with you all this morning. We have a couple of topics to talk about. The first thing, which was a follow-up from something that was discussed in the prior meeting, I believe the chair requested some trustee education that was done previously, just because we do have 2 new members on the board, and the education is more so about the roles that kind of all of your different service providers play and provide in support of the board's facilitation of their duties, right, for the pension plan overall. So if you go back to the tablets, this starts on page 62 is the first one. And the good thing is you have most of your service providers here today anyway, so they can even add in, because I'm sure this does not do them service, right? They do a lot more than what's noted here, and they can fill in the blanks. But the first one on page 62 is the actuary, right? And we just heard from the actuary who gave the annual valuation report. This is one of the primary reports that he provides on an annual basis. But you can kind of almost think of him as Oz, right? He's the man behind the curtain. He knows the future. He takes in all these crazy assumptions, and anytime you guys want to do anything creative, right, he's got to come up with a solution, and working with the city and lots of different things. So he's the man behind the curtain with all the math answers overall, taking into account lots of assumptions, right, mortality, all these other things to kind of help move the plan forward and give you the numbers you need to make good decisions overall and keep you on track. The next is the attorney, which obviously provides you not only ongoing advice to make sure that you are in compliance with ordinance and state laws, and educates you on changes, on what's going on in the legislature from year to year, but primarily also it particularly gets more involved when you have things like disabilities and things of that nature, and counseling you through those types of matters. And obviously you're going through an RFP right now for attorney services, so those are the types of things that you'll be looking at as far as their capabilities that they can provide. But they're here to provide ongoing counsel, and then know that, and this is kind of more broadly, not only for the attorney, but for us, the actuary, the plan administrator, because there are sunshine laws, right, and you all cannot speak to each other about board business in between meetings. You can always talk to any one of us, though, at any time you wish, and that is not a violation of Sunshine State law. So you can always feel free to contact your attorney in confidence, or any one of your service providers. The next on page 64 is the consultant, which are the roles that Carrie and I play here for the board. We went over a little bit of this last time, but essentially we will select and monitor the investments in the plan. We will do that in accordance with an investment policy statement that the plan has, which outlines the criteria for what we look for when we select and look at plans and managers on an ongoing basis. It would also have in there asset allocation targets, because as your assumptions change, your allocations will change. We'll make sure that you are remaining within appropriate thresholds to those asset allocation targets, which is something that we discuss as part of our ongoing report overall. But really anything and all things investment related, if something comes down, even from a legal or regulatory standpoint that will affect the investments, we'll make sure that gets implemented appropriately inside of your portfolio. And then managing trades and things of that nature, working with the plan administrator and your custodian. The last specific section on here is page 65, which is the plan administrator, and I know there's a whole host of things here, and when I say that we're probably not doing it service, I mean, if Patrick is Oz, Chrissy's essentially the quarterback of the team, right? Everything goes through her as kind of the coordinating in between meetings and things of that nature. She obviously works closely with the chair on facilitating board business, but is also a resource for all of you, for your members to go to on an ongoing basis. I know that she has some other slides maybe that cover some of the things, but you just hired the plan administrator because you realized all the duties and everything that went into that overall, and you saw the value in that. So very high level as far as the different roles that all of the service providers play. Any questions from new board members or current board members? You're welcome. And then Carrie and I, we're going to tag team the rest of the performance results, which, as Patrick alluded to, are very good for the fiscal year.
Yes. Great, so I will kick us off for your September 30th end of fiscal year book review, just starting on page 3 in that book. Yes. Thank you. So in the top right section there of page 3 of that September 30th book, you can see all of the bars there go to the right. That makes your consultants very happy. That means essentially every segment of the market was positive for the quarter. And I think there's, a few things kind of going on in the background. Obviously, it's been a couple years now since the Fed really started hiking rates in 2022, 2023. Remarkably, nothing has really broken. That recession that was so well forecast really kind of never showed up. GDP remains incredibly strong, kind of on the order of high 2%. Consumers are still spending. Inflation is getting under control. And I think kind of put all those things together, and it just goes to the resiliency of the economy, and I think the results that you see there on that page. Sentiment was kind of negative, if you remember back to September 30th. We were approaching the election. We were about a month away, so sentiment was kind of negative, but in the numbers, everything really remained very strong, and so we got, as you can see, over 5%, almost 6% from the S&P 500, over 9% from mid and small cap segments. And I think one thing we did see here too was a rotation away from some of those, Magnificent Seven or FanMag stocks that we've spoken so much about. There was much broader market participation as well for the quarter, which was a really good sign. So very good U.S. equity market results, and just to finish out September, we obviously got a 50 basis point rate cut from the Fed, which was stimulative as well and just put us on really solid footing from a U.S. equity market standpoint. Internationally, they're in the middle of that chart on page 3, top segment, and kind of yellowy orange. You can see the overseas indices, pick one, whichever you look at, up very high single digits. So the EFA up over 7%, kind of the all country up over 8%, and emerging markets up almost 9%. A lot of this was currency translation, so the dollar did depreciate when we got that cut from the Fed. So nice kind of local translation to dollar was actually beneficial there. But in the emerging market segment, actually we saw a nice rebound, particularly from China, as well as other markets like Taiwan and Singapore too. China's been very undervalued from kind of a PE standpoint. Overall, the equities were trading at about 9 times earnings. You did see the Chinese government step in, say they were going to do some, stimulative things to help prop up markets. That was favorably viewed, and so that was kind of a strength there within the international indices for the quarter. And then last but not least, within kind of the red segment within fixed income, the full aggregate of kind of 1 to 30 maturity bonds was up over 5% for the quarter, a lot of that on interest rate movement. And from there, I'll move to what is, in our books, page number 10. The bottom right chart there, where you can see kind of the changes for a 4-quarter rolling period. If we start with the yellowish orange line, that was where we ended June. The blue line's where we ended September. You can see that pretty dramatic drop in interest rates across the curve, not just on the left-hand side, which is heavily impacted by what the Federal Reserve is doing with rates, but kind of all across the curve there, you see rates really coming down, which gave us that nice return for fixed income. And it's been a very volatile time for interest rates. So to give you just kind of an idea, The 10-year moved 50 basis points just over the quarter. That's 0.5%. That's very significant within fixed income. And rates do remain volatile. We're at a higher level than we were kind of even at the end of the quarter. But one thing to note is we've talked a lot about, and we've been in for a little over 2 years now, this inverted yield curve situation where, you know, for over 2 years, you could get a higher yield holding a 2-year Treasury bond than you could holding a 10-year Treasury bond. And historically, when you see that inversion, that's been a sign of a recession to come. Well, as I mentioned, really has yet to come, and we saw that 2 and 10-year actually normalize through the period, where the 2-year is actually now earning less than the 10-year. So you're seeing that 2 and 10-year inversion correct. The front end of the curve, obviously, still inverted, but as the Fed cuts, obviously, again, we got 50 basis points in September, we got 25 basis points yesterday. That may normalize, and you'll see the curve kind of steepen out a little bit. But again, that drop in rates that we saw for the end of the quarter there certainly helped us from a fixed income pricing standpoint and gave us that nice pop. One other development that I think was very cautiously optimistic about is that real estate index that we've seen kind of draw down and be negative for about the last 8 quarters and about 20%, about a 20% pullback, was marginally positive for the quarter. Obviously, lower rates is going to help that, but hopefully that's a sign that we're starting to find our footing again with about a 20% correction in real estate over the last couple of years. So really nice kind of economic environment to finish our fiscal year. We were firing on all cylinders. And as Jorge will get into as he kind of covers the performance for you, it really kind of put us over and above for the quarter, the roughly 5% that you did earn due to very strong results across all markets. Over to you.
Thank you. Any other questions on economic backdrop before we get into results? So I have one of the tablets up here, so I'll try to call out the tablet page numbers. Page 79, you should see 2 big pie charts next to each other. It shows, just to give you a picture of the balances growth over the quarter at least. At the end of June, you're at $23.8 million. You ended the fiscal year 3 months later at about $24.9 million. So a gain of just about $1.1 million over that final quarter leading into the end of the year. At the following page, page 80, you will see, just to highlight the fact that you have made 2 investment changes over the past quarter. One was done earlier in the most recent quarter, which was the replacement of Allspring with MFS, and the other one was obviously WAMCO that we replaced with Baird as a result of some of the issues that Ken Fisher, who was the CIO of WAMCO, was facing at the time. At the time, it was just allegations. Now, since then, he's been criminally charged. He's out on like $10 million bail. He's been charged for fraud. So all sorts of things. Things have turned from bad to worse for Mr. Fisher and everybody at WAMCO. So great that we were able to sidestep that and get out on the front end of some of the outflows that have been happening from Western Asset. But those 2 trades and changes in your portfolio have both been done and implemented both over the course of the last quarter. On page 14, this goes back to what I mentioned with the IPS and having targets for each one of your asset classes. So here on this page, we actually will tell you what your IPS target is for each one of your asset classes and then where you are currently based on the values that you hold inside of each one of those asset classes. So you will see that you're, yes, a little overweight domestic equity, which is good because domestic equities have been providing most of the returns in the market, so comfortable with that and still very much within the thresholds. You have about a 5% threshold overall, so plus or minus 5%, we don't need to take any action. You are getting a little underweight domestic fixed income, but we are holding a little bit of excess cash here, so when you kind of consider the cash as part of domestic fixed income, that brings you a little bit closer to your target. And I think with some of the things we've seen more recently with rates kind of ticking up, which I think has been a very interesting factor, right? So while the Fed is on this rate cut cycle, 10-year rates have actually gone up. They went down initially and then shot up. They've gone up almost 1% since then. They went from 3.6 all the way now to like mid-4s, which is why people are asking, why aren't mortgage rates going down even though the Federal Reserve's cutting interest rates? Well, it's because inflation is going up and expected to be sticky. Growth is expected to be pretty good. and we're going to continue to run deficit spending overall. So all of those things together have put upward pressure on rates. We have budget conversations going on. I know a lot that's been in the news even the past couple of days. So lots of things with the administration changeover. So I'm comfortable keeping some excess cash right now and realizing a 4% coupon instead of maybe putting it into what might be a more volatile market, which you've seen over the past couple of days, or a fixed income environment where we continue to see there's probably more upside. I see more catalysts for rates to actually go up than there are for them to go down, at least in the short term. So I'm happy keeping kind of a little bit of more excess cash right now. So I say all that to say we don't recommend any rebalance activity at this time. Any questions on that page? Because it is the end of a fiscal year, I like to touch on page 83 here of the tablets, and this just shows you kind of a reconciliation of the year. So particularly the contributions and distributions column, just so you get a sense of what's coming in, what's coming out. So you received about $1 million into the plan from all contribution sources, right? From member sources, city, state contributions into the plan. You've paid out about $900,000 in benefits over the trailing 12-month period. So just to give you a sense of outflows, about how much is coming in versus how much you're paying out in payments and benefit payments overall, you're essentially pretty neutral, which is ideal and typical of a plan like this, right? That still has membership contributing into the plan. It's an open plan. It's a very neutral type of situation overall, which is great because as much as we can offset cash going out with cash coming in, that means we can leave the investments alone and they can still stay invested in the market as longer without being disturbed and having to be sold to make payments and things of that nature. So you're in a very good cash flow situation overall. Just also highlighting there on that page, just the appreciation that you've seen in your values over this past year, over $3.3 million just in appreciation of underlying holdings and almost $1 million in income from dividend payments and other distributions that were made from the investments in your portfolio. So now that I've delayed enough, page 84 gets you to fiscal year returns. So for the fiscal year, you came in at 20.78%, 20.75 net of fees overall. So very strong absolute number. Anything above 20, I think anybody would be happy with in any year overall. Yes, it was slightly below your policy benchmark. Most of that had to do with obviously some active management underperformance we had earlier in the year with Allspring that obviously we addressed, plus your little overweight to real estate, which has been obviously one of the only negative part of the market over the past 12-month period. So we are getting close to on target for real estate, so it's getting better there. But those two things together caused us to slightly underperform the policy benchmark, but still you did better than most peers in the 40th percentile and good obviously on an absolute basis. Even looking longer term, 5 year, 10 years since inception, all those numbers continue to be very, very strong, top decile and very competitive with your benchmark and peers overall. If we look down below that, just looking at some drivers, MFS obviously was a new addition that replaced Allspring. Haven't had it for a full quarter, so you don't see a full quarter's worth of performance there, but did do well throughout the past 12 months. Dodge and Cox, same thing. They've been pretty competitive with their benchmark. Eaton Vance has done phenomenally in the small and mid-cap space in the top quartile there over the fiscal year and even over the most recent quarter, outperforming by about 1.4 percentage points over the Russell 2500 index. So very strong active management contributions there from Eaton Vance. On the following page, we have Euro-Pacific growth. They've been struggling a little bit. Carrie touched on a lot of different turmoil that's been happening in international markets. We've continued to see a lot of that even so far this year. So a lot going on there. They went a little bit underweight to emerging markets. So obviously as China came back, that caused a little bit of lagging. But I will tell you, when we see the flash report that we're about to touch on, they've done very, very well so far this quarter in the face of some of that turmoil and adding value over the benchmark. So we'll get to that in a second. Baird is here. That replaced the Western Asset Fund. Again, too short to have any performance here, but I can tell you they're up 3.3% for the year, which puts them above the Barclays Aggregate Bond Index. And then at the bottom there, you do have intercontinental real estate, which almost positive, only down 0.99 over the most recent quarter, down 11% for the fiscal year. We are realizing, I was taking a look at your distributions there, you get about $26,000 from them every quarter in cash distributions. We're not reinvesting that right now in real estate, and kind of the expectations I've been setting for commercial real estate is that while we think things are getting better, by all means, do I think that there's going to be appreciation that gets realized in the commercial real estate market? I still think we're far away from that. But at least we might get to a point where you actually realize the yield of the properties that you hold. So my expectations for commercial real estate are probably low to mid single digits. Hopefully we get there over the next 12-month period. We return to that kind of environment. And then we can talk about appreciation probably in a couple more years, but I don't think the real estate market's there for a big appreciative boom, at least at this point. But at least positive. We're getting closer, at least where it's positive. Any questions on any one of your underlying holdings or portfolio performance?
Oh, I agree that the real estate has not been performing well, and I see in your asset review that you were talking maybe about reducing that a little bit, and that may make some sense.
Yeah, and that is a little bit of a wish list item. We have some liquidity issues that would prevent us from doing that immediately, but it's definitely something we want to keep an eye on as a possibility. The last thing I'll touch on before I get to that slide then is the flash report. So if you go to page 113, you'll see what you've done so far in this fiscal year, building on the great 20% return. Hopefully, we'll try to get you there again in this fiscal year period. But with the flash report that is on page 113, you will see that you're up about 1.9% so far, 2 months into the fiscal year. So good, very good progress. And that's with the fact that international has done poorly since this quarter. Fixed income has also been challenged this quarter. Really, it's been domestic equity that's been leading the market overall. So to that respect, even though fixed income and international have been the most challenged parts of the market so far this quarter, those are actually the two managers that are actually providing the best outperformance against those benchmarks for you in the portfolio this quarter as well. So you're getting good domestic equity performance so far this year, and then you're having outperformance in the segments that are actually struggling overall. So that's what's caused you to be 1.9% and even above your policy index so far, 2 months into the new fiscal year. So with that, then we can go to page 118 of the report. And this is not a full-blown asset allocation study, but something I just put out there because we did at the last meeting decide, right, that you were going to change the expected rate of return from 7.45 to 7.35. So just giving you an idea of where you stand today based on our capital market assumptions versus your assumed target that we're using for actuarial purposes. So on this page here, what you see is the current target, and what you see is an expected rate of return of about 7.6% using our assumptions for what we think each one of these asset classes are going to return over the long-term period. You do see a couple scenarios where you can dial back the equity risk, so invest a little bit less in equity, and that does take down your expected return marginally, but you have to really dial down the equity risk pretty significantly, almost 5% just to get down to something close to what your current actuarial assumed rate is. And I would say that it's not uncommon, and actually usually, because there's a lot of wonkiness that goes into some of these capital market assumptions, you usually want to overshoot your assumed rate by a little bit because there's some, there's decay and other things in the assumptions and how they work out when you start to compound them over time. So I'm comfortable, actually, even though you reduced from 7.45 to 7.35, with you staying with your current asset allocation targets. I think a 65% equity allocation is very healthy for a plan with your kinds of dynamics, open, with your membership characteristics. I still think it makes a lot of sense to remain with that level of equity overall. I will say that in the future, I would love to maybe get down to a point where if we have this 15% alternative bucket, that we take a little bit more maybe away from real estate and equally weight infrastructure to real estate. Again, because I don't see that there's a lot of appreciative maybe potential in commercial real estate over the next couple of years. I still think they have a lot to work through. And infrastructure, I think, is just a pretty solid segment of the alternatives marketplace, where you can kind of, particularly at Brookfield, you can count on that 2 to 3% return every single quarter overall. I think it makes sense to kind of balance that out. And the only reason I wouldn't want to do that now is because we can't sell enough of Intercontinental to get us down to target. So I don't want to change the policy benchmark target when I can't actually follow through on changing our actual real estate exposure. So once we actually are able to transact with Intercontinental, I think it does make sense to re-examine bringing down that target maybe to something a little bit lower overall. But at this time, not Intercontinental specific, commercial real estate, all open-ended funds, you just can't sell, right? You can't redeem any assets. And if you are, they're giving you drips and drabs, right? Nothing on the level of what you would want. Any questions on that, or any comments on maybe what you want to see from an asset allocation standpoint?
I know you, excuse me, you commented on fixed income earlier that we're a little bit below that, and we are like 15.5% versus 20. Should we be looking to do something with that?
Yeah. So you are sitting on, and even the excess cash situation that I talked about at 9:30, since 11:30, it's only increased your excess cash. I've been advising to wait until the March meeting for that, because at that point in time, right, we're past the change of administration. We're past, hopefully, some of these debt ceiling, budget conversations, which I think is introducing just some more volatility, not only in the markets, but also in the fixed income markets overall. I think we'll have a lot more clarity in March and a lot more comfort as to then kind of putting money back to work in fixed incomes. I do think it makes sense to put some in fixed income with yields as they've come up. The overall yield and duration is kind of attractive now with the yield curve, but there's just so much movement right there and so much uncertainty in the next couple of months that I'd be happy just clipping the coupon and the low volatility of money market until March. But at that point in time, I think hopefully things have calmed down a little bit, and then we'd be very comfortable putting it to work.
Makes sense.
In your underweight of fixed income. At least that's my plan, but I'm open to comments or.
Anybody? I noticed you also were looking at, a possible change in the equity, and we do much better domestic than we do in international, so I would think that would be something to look into as well, that take some out of international and move it into domestic.
And that is something we could do immediately. So right now, if you look at your equity allocation, you are 50% domestic, 15% international. So that equates to about 23% of your equity target is international. And there's been, which is already is underweight. If you look at the global market capitalization, it used to be about 50% US, 50% global. It's shifted over the past couple of years. It's now almost 70% US, 30% global, but still, even with a 23% proportion of that to international, you're still even underweight what the global kind of makeup is. But given just the international struggles that they've had historically, and just their failure to kind of deliver, they've outperformed once over the past decade, twice over the past 12 years, domestic markets. A case has been made that reducing international equity as part of your overall equity sleeve is potentially warranted. So internally, I kind of like a 15 to 20% target of your international, toward international. Carrie, I don't know if you have any thoughts.
I think that's pretty much spot on, yeah.
And that is something we can do and does not really have any material impact on the expected rate of return of any one of these portfolios. If we wanted to reduce that to, say, a 20% target, equity target, instead of a 23% target, which is what you have today.
And to be clear, could do that under your current investment policy. Without having to change your targets, you can kind of strategically underweight by 1% or 2%.
Right.
And still be within your band.
Anybody else have any thoughts? What are your, any recommendation of what to do for that?
I would certainly recommend changing. We can strategically underweight it now and officially change the target at the next meeting with the IPS, because that would obviously be an IPS change. But still within your bands, you can bring that down to 15%. I'll do the math, but I think it'll bring it down to about a 13% target for international, 52% target domestic. But just to start moving us toward a situation where we are overweighting even more domestic equity versus international equity. I think international equity has a lot of headwinds ahead of it. And every day it seems like something else is happening, right? Resignations every day in Canada, Germany's collapsing, France is collapsing, their economies. China's obviously in deflationary mode. They're doing hundreds of billions of dollars of stimulus to try to get things going there. So South Korea can't decide if they're going to be martial law or not. It's just like one thing after the other everywhere you look across the globe.
I think that would be a good move to alter that a little bit. If my numbers are correct, looking in your material, domestic income over the last 5 years has given us like a 15% return, where international is more like 7.5, so half. And over 5 years, that's, to me, is a long enough stretch to feel comfortable that that's the way it's going. So I personally don't have an issue, but what do the rest of you think? Anybody interested in doing that? Would you make a motion, or we'll just let it drop?
I wouldn't be opposed to it. I still, if I'm thinking about a strategic model, to me, I'm looking at like, okay, are we selling low instead of buying low? If we're reallocating now that we've said, oh, international's faced all these headwinds and it's underperformed the last decade, and now we're going to underweight it even further, which means we're selling into a down market. I mean, but if you think there's sufficient tailwinds that justify that, I'll leave that to you.
Yeah, I think that's been the rub the whole time, right? Is that we, for years, have been saying that same thing, right? Everything that we've learned in finance will tell us that there has to be some event that causes some mean reversion here. There has to be some, based on valuations and other things. Like it has to finally do better at some point in time, and then year after year after year, it never materializes. I think that what gives us a little bit more comfort is that the globe has changed enough where we get so much exposure now. Even U.S. multinationals get so much of their returns and revenue from international sources that I would say that even with a strong U.S. bias, you kind of already have implicit kind of international exposure through that, because no matter where in the world things are happening, it kind of eventually always ties back to some U.S. company at the end of the day, which gives me a little bit more confidence in being overweight U.S. equities. But yeah, to your point, it always something that it plays in the back of my mind too. At some point in time, it has to come out. It never seems to get over that hump where it actually does become competitive. And I think maybe it's more has to do with the way their economies are set up, right? This is what happens when you have these kinds of regimes and these companies. You get just economic malaise and staleness. And they just can't
to be clear, I'm not trying to hold Jorge here to having a crystal ball. Nobody's got it. No, I actually completely agree that going underweight to international is a reasonable decision, and I just wanted to sort of flesh that out a little bit for everybody.
No, thank you.
Well, based on what you two just said, and what you also mentioned earlier about the fixed income and waiting for the 3 months to go by and the administration to change and all those things and all the upheaval that's going on in the world, would that be a sensible thing to do with this? Just hold off till our next meeting and come back with and then you'll have time to come back with a recommendation of what it is you want us to consider liquidating and where we would put the money.
Yeah, absolutely.
So
we'll have a lot more insight into what happens with some tariffs issues and things like that.
Yeah. So I think that makes the most sense.
Yeah.
Okay, so let's put that as an agenda, Chrissy, and we'll deal with it that way.
Perfect. I didn't have any other comments on our sections.
Yeah, no, I don't think I did either. Just wanted to say, again, welcome, Danny, Garrett, great to work with you both. I've been on your account for, I think, about 6 years now. Jorge's kind of new to being my co-consultant here for about the last couple of years. I made partner a couple of years ago. My role changed a little. He's already in town because he works with Northport, so it's kind of a very natural partnership, and he's been a big help to me. I will be at most meetings. I will be out in March. I have a conference to go to at the same time, so you'll see just Jorge in March, but I will be here for all the rest of the 2025 meetings. And again, really comes in handy because he's totally up to speed and an excellent consultant. So typically you'll see both of us, but we do have that nice kind of backup system as well in place. So thanks for the time. Look forward to working with you all. Happy holidays, and thanks again.
Thank you, Carrie, and you too.
You got it.
Carrie, before you step down from the podium, since the board did approve the October 1, 2024 actuarial valuation today,
good call,
the board does need to declare their long-term expected rate of return for the next year, the next
The
several
next
years?
several years and the long term thereafter. Thanks for the reminder. I typically jump up after the valuation, but I failed to do that. So 735, in my opinion, is reasonable. If you look at your long-term numbers, you have absolutely hit that and then some. So what you can basically say is, with the advice of our consultant, we expect that we will earn 7.35% for the next year, the next few years, and the long term thereafter. And you can just say so moved. The attorneys I've seen that several times. They'll say, you can just say so moved. It's a formality for the state of Florida that has no real meaning, because we can come back to the table next year and say, what about 7.2 or something? It is a checkbox where they are looking for you to declare an expected rate of return that matches what was in your actuarial valuation. It's truly just a match-up kind of checkpoint. You are not committing formally to 735 for truly the long term. It's language that is a state formality, just so you know. Yes, if somebody could just say so moved and you could just vote on that, that'd be great.
So moved.
Very good.
Do we have we have a second? Second. All those in favor, signify by saying aye. Aye. Opposed? Motion carried.
Thank you
Thanks,
very
Carrie.
much.
Thanks, Carrie.
Okay, Chrissy.
So for my section, I do have a few slides, and they were separate from the packet as well. So if you don't mind going back to the home screen, using that little back arrow and just clicking on trustee education. Jorge, I appreciate where'd you go? There you are, brief introduction. So the TPA, or third party administrator, or total plan administration division of Foster and Foster, it's not just me, okay, right? So I included a photo. We had a company gathering this year. Every year we go on a retreat. We have offices all over the country. So we pick a location and we go and we have some fun, but we do business as well. And so this is a photo from our recent gathering just showing some of our staff. My point there being, it's not just me coming to your meetings every 4 months. Joe can tell you there's a lot of work that goes into total plan administration, a lot of state requirements. Those keep increasing every year. And we work with all your consultants to make sure that the plan is administered. So basically, the second slide is just some of the things that we do that you guys don't have a chance to see, because this is the day-to-day business that we're doing in the background. That's what you pay us to do. And I know Joe is very happy about that. We serve actually almost 100 plans at this point. So while yes, we are busy, we certainly couldn't do it without our whole team of people. But our experience makes us very good at what we do. I mean, we have a lot of resources. It's like that sort of that boutique service, but we have a lot of resources. So we also have, the Foster and Foster Actuarial Division, totally separate contract. So while we're the same company, different contracts, but I actually work in the same office as Patrick, and so it's very easy for he and I to work together on things. We work with the Board of Trustees, whether it's you're working with the city on elections and appointments, any resignations. If you guys want to travel and go places, we work with you on registrations and reimbursements. Any Form 1 questions you might have. The board meetings, we handle the scheduling, rescheduling if needed, making sure there's a quorum, making sure things are posted properly, getting the agenda packet to the city. Preparing for meetings is no small task, especially when you're someone like me who's pretty OCD and needs things to be exactly how I want it. I take the minutes. There's always some action items. We, of course, work with members. That includes plan retirees as well. Once somebody retires, doesn't mean they are no longer serviced by Foster and Foster. We certainly have retirees, including those in the PREA, who have needs. Even regular retirees who aren't in the PREA, who just might need to change their address or direct deposit information, or maybe their spouse passed away and they want a joint annuitant recalculation. So we work with members. We do the policies that cover the board, or at least we facilitate the renewal of your insurance policies. We work closely with the city of Punta Gorda on anything that they may need from us, things that we may need from them. I think we have a really good relationship, and it's been a pleasure. Fund management, we work with Mariner and your investment managers to move money around as needed. Any of the mandatory filings, postings, reporting, we handle that. Your online portal, making sure everybody has a beneficiary. If there's any disability review procedures, those disability affidavits you guys want to go out, we'll handle that. So it's a lot more than me just showing up at meetings every 3 months, and I know we might make it look easy, but there's a lot involved. We have multiple staff members, so I can't do this all myself. We have an administrative assistant, plan analysts, which are mostly support staff, so you may never meet the analysts per se, but they're there and they're doing a lot of the boots on the ground type stuff. When I'm on the road and client facing, they're really getting in the weeds there, which is great. Your plan doesn't have an assistant plan administrator yet, but I think if member activity ramps up and there's a lot of it, Candace, she's my colleague who is the assistant on the general employees plan, then I would ask her to help out with this plan as well. So far, I don't feel I need assistance on the member front, but maybe one day that will become a thing. We have someone in billing. Actually, now we have a second person hired, so 2 people handling all of the invoices. Our record specialist, Melanie, she makes sure everything is in compliance. Public record requests are fulfilled. All the ordinance are filed appropriately, any capital calls. And then the plan administrator, me and the others, we do everything else. It's a lot, basically. The plan administrator is not a one-person job, so props to you, Joe, for even doing it for as long as you did. And to Ray, or was it John Briggs? John, I mean, it's definitely no small feat, especially for a firefighter to be doing. Like, seriously, props to you. But we handle all of this. So if there's anything you guys ever need from Foster and Foster, if you're not sure if we handle it, please reach out, because there's a great chance that we do. And if we don't handle it, we can get you to the person who does. We work with your actuary, of course, that's Foster and Foster, Patrick Donlin, your attorney, as needed. Your plan doesn't have an independent auditor. Some plans do, but if the city has any requests from the city auditor about the pension plan, we'll help out with that too. We work with your custodian, Salem Trust, again, Mariner, your consultant, and the managers. So it's a big job, and if you have any questions about the role of the administrator, I'm happy to answer them, but
It is a big job, and you've been doing it well. Thank you.
thank you. I appreciate that, and it's been a pleasure. The next item under my section is not anywhere in the packet. This is just something I wanted to alert you to. Going forward, instead of getting an email from a person at Foster and Foster, in the past it's been Stephanie Donahue. She has left us. The administrative assistant position seems to have had some turnover. So we decided to create a quorums email address. It will be quorums@foster-foster.com. That is a legitimate email address. It is a safe sender. And that will be who reaches out to you to say, hey, will you be at this meeting or not? So please be responsive to that email. I can send you a quick follow-up and just say, hey, add this as a safe sender or something so it doesn't go to spam. You guys have been very responsive, so I appreciate that. And just wanted to give you the heads up on the quorums email. Any questions about that? Okay, and just for clarification, quorum would be, we just need 3 of you physically present. As long as 3 of you are here, it doesn't matter which 3, the meeting can go on, but if there are 2, we can't do any business. What's next on the agenda? Board memberships. The first one, and I guess you could go back to the packet. You don't have to, though. I think last quarter I talked a little bit about the Florida Public Pension Trustees Association, or the FPPTA. They put on 2 trustee schools a year and an annual conference, and they do a really good job. I think the conferences are more social and networking, but a good place to go if you're looking for a new vendor or you want to talk to other trustees about maybe issues they've had or really anything at all. It's great for socializing. The winter trustee school is coming up in January, although you guys do need a membership to go to any events, so I figured today would be the day to purchase a membership for 2025 if you do want to take advantage of those opportunities. The membership for FPPTA is $750 for the full calendar year, and it covers all board members. From there, each event has an individual cost as well. If there's ever something you want to go to, if you do happen to join, conferences are pretty expensive. We do expect you to contact Foster and Foster, and we'll send a check to cover the cost of any registration. So I've said quite a bit there. Let's start with, do you guys want to sign on with a membership for FPPTA? And if so, a motion would be in order to do that.
Yeah, I brought it up the first meeting. I'm planning on attending the classes, get certified. It's just going to make me stronger in this position. So I would like to make a motion to become members.
I'll second.
So Danny did allude to, there is a program with the FPPTA, it's the Certified Public Pension Trustees Certificate, which used to have a recertification fee. They actually just did away with that, which is nice, but there is an additional cost to joining that CPPT program. Do you want to start that CPPT program at the winter school? That's coming up in this January.
Yes, ma'am.
You do, okay. So are you already sure that you can attend that? Because if so, I'll add it on my task list and get you registered when I get back to the office.
Yes, ma'am. It's,
Okay, awesome.
yeah, January 26th through the 29th.
Correct.
Already in the calendar.
So I will book your registration. We'll send a check to cover the cost. You'll get a confirmation email that has a link to book your hotel room, and I suggest you do that sooner than later to make sure you're in the host hotel and not somewhere down the street where you have to take an Uber to the conference every day. So look out for that email, and then we'll work with you on reimbursements for per diems, or I don't know if you have a P card you can take from the city. But we'll look at the travel policy and anything like that that we can get, so you're not spending money out of pocket. And if you do, you'll be reimbursed. Anyone else for the winter trustee school, since you're now officially members? Okay. So entering in the CPPT program, Danny, you're gonna be taking all the basic classes. There's also a test at the end of your, of the winter school. I'm not sure if it's open book. In years past, it's been open book, but I think they changed it, so study hard. I'm sure there's a lot of trustees who are also starting it for the first time and also are like, help, so it'll be fun. It'll be just fine. So you'll be certified after attending 3 schools. Okay, so winter school, if you can attend the fall school in October of 2025, that would be your intermediate classes. And then the next winter school, I guess, would be January 2026. You would pass advanced and become certified. So it's a commitment. You sure?
I'll be attending in October.
October, okay, so you want to do the fall. Now, that's tentative, right? I mean, that's pretty far away, but I'll put it on my notes and then just confirm with you
Yeah.
later. I'll always list educational opportunities on the agenda.
Yeah, it's fine. We have to schedule way out anyway.
Okay, so, okay, and anyone else, just shoot me an email, and the sooner the better. Like I said to Danny, if you want to go somewhere, it's better to book your hotel in advance. So, the sooner the better.
Do you have the dates for the October session as well? Because that's the plan, I just don't know the dates of. I can look on the
My
website.
computer's not connected to the internet, but I will send you guys the dates for, let me add that to my task list. Send education dates to, I'll send it to all of you.
Yeah, barring, obviously, any scheduling conflict, I'll be rolling right through it.
Hey, Chrissy, I got it for you if helpful.
Perfect.
It looks like it's October 5 through the 8th, and that's going to be at the Sawgrass Marriott, so that's going to be in Ponte Vedra Beach, Florida, like kind of in the Jacksonville area.
Yeesh.
But it's October 5 to 8.
Thank you, Carrie.
You got it.
The other educational organization that I've recently become privy to is the International Foundation for Employee Benefit Plans, or IFEBP. I actually got this from my Fort Myers Fire trustees. They are members of this, and we're going to have, I shouldn't say we, they are, the IFEBP is having an investments institute in Fort Myers at the Luminary downtown in April, May of 2025. So I did include that if you wanted to consider joining the IFEBP. I know they have like a prorated, let's see, prorated membership fee. It looks like it depends how many of you join, if you want to join at all. And you can also join later in the year for a prorated membership if you're interested in joining that organization. I just present you these things. I have no affiliation with any of these organizations, and I don't care either way. I think education is important, but you're under no pressure to join IFEBP, but I figured I would share.
Thanks, Chris.
You're welcome. That concludes my prepared remarks today. Thank you very much.
Anybody got questions for Chrissy? Any trustee comments about anything that you'd like to share? If not, welcome to all our visitors. It's always nice to see you guys. And Kristen, always nice to have you here with us. I hope everyone has happy holidays, and we stand adjourned. Thanks.